Welcome to this video on basic inventory revision. Now, this video is meant to just consolidate the main principles of IAS2, but on a really basic level. So if you're looking for more advanced discussion on manufacturing, inventory, and so forth, it's not in this video. Okay, welcome to this video on basic inventory revision. In this video, we're just going to consolidate the basic principles of IAS2. And later on, I'm going to do a more in-depth video on manufacturing inventory and the main principles around that. But for now, we're just going to look at the basic principles of IAS2. Now, before we get into IAS2, I think it's important to understand how we get to IAS2. And what do I mean by that? The first thing to understand is the importance of the conceptual framework. So the conceptual framework would set out for us the definition of an asset. So it both defines an asset and it gives us the recognition criteria. Okay, and in terms of the conceptual framework, an asset is a present economic resource controlled by the entity as a result of past events. Okay, so that's the definition of what an asset is, and it also tells us what an economic resource is, but you can go and recap that for yourself. And then it gives us the recognition criteria, and basically we only recognize an asset if it meets the recognition criteria of relevance and faithful representation. So the importance of the conceptual framework is it tells you if I have an asset. Okay, so does an asset exist? Okay, that's the importance of the conceptual framework. Now, the next part to consider is, well, if I know that an asset exists, what is the asset? And that is where IAS2 really comes in, because IAS2 tells us whether the asset that we have can be classified as inventory. And in terms of IAS2, it gives us really three things or three scenarios in which we can classify an asset as inventory. So the first is, it's the common definition that we all understand, and that is that it is held for sale, okay, in the ordinary course of business. Ooh, handwriting getting a bit messy there. Okay, so it's held for sale in the ordinary course of business. Now, a lot of there could be different assets that are sold, right? A business, for example, could sell a machine, but if that machine is not sold in the ordinary course of business, then it cannot be classified as inventory, and then it would probably still be classified as a disposal of PPE. So it's important to understand that it must be in the ordinary course of business. Then the next aspect of the definition is it talks about in the process or production of or production for such sale. Okay, so you're producing it to sell the asset. Now, really the importance about this part of the definition is that you could have an asset that is still incomplete, so you're in the process of completing it, but the intention is that it is going to be sold in the ordinary course of business, and so in that case it would be classified as inventory. And then the third part is any materials or supplies that are consumed, okay, in the process of rendering, in either in the production process, okay, in the production process, or rendering a service. Okay, so if we have consumables that are being consumed in the process of production or in the process of rendering a service, then we would classify that as inventory as well. Now, the next thing to think about is the measurement of inventory. Okay, so we're going to talk about measurement now. Now, when we talk about the concept of measurement, it's important to understand that there really are two parts when it comes to measurement. So we talk about initial recognition, and that is the first time that the asset comes onto the financial statements, and we talk about subsequent measurement. And with regards to initial recognition, it's quite easy with inventory because initially it's going to be recognized at cost. Now, when we talk about cost in the context of inventory, right, we have to understand that cost includes the purchase price. Okay, so it could include the purchase price. It could also include costs of conversion. So that would be, for example, when you are manufacturing your inventory, and there are other costs that you incur in the process of converting your raw materials into a finished product. Those costs would be included as well. And of course, costs incurred to bring the inventory to its present condition and location. Okay, present condition and location. So these are the costs that we're going to capitalize to the cost of inventory, costs that are necessary for us to incur in order to get this inventory to the present condition and location. Okay. And then if we think about the measurement side, well, subsequent to recognition, it's important to understand that within IAS2 there is this central measurement principle, right? That inventory is measured at the lower, okay, of its cost or the net realizable value. And this is really important because this really is this is the key principle of IAS2. Inventory must be measured at the lower of cost or net realizable value. So after the first time that we bring inventory on the books and it continues to be on the books, we have to ask ourselves, right? Is there potentially any indication that this asset is impaired? So is the net realizable value, has it gone below the cost? And if it's gone below the cost, then it presents a problem and we would need to impair the asset. Okay. Now, in the process of measuring inventories, we need to think about how a business actually records inventory. So in terms of recording the inventory, there are really two methods that they can use. So the first method is they can use a perpetual inventory recording method, and the second method is they can use a periodic inventory recording method. Now, a perpetual inventory recording method is usually used by big businesses, okay? And the reason that it is used by big businesses is because they have the necessary hardware and software to be able to track the movement of inventory, okay, in real time. Okay, so they may have scanners that are scanning barcodes and so forth. So they have really sophisticated systems that are able to keep track of their inventory at any given point in time. And the important thing about this perpetual system is that anytime our inventory moves, so when inventory moves, okay, we update the general ledger inventory account. Okay, so that's really the important thing here, that you're updating the general ledger account every time inventory moves. The benefit of this is that you always have a sense of what inventory, or you at least have a sense of what your theoretical balance of inventory is. And what then happens at the end of the year is that you would have an inventory count or a stock count, and with that inventory count you would compare what you have counted in terms of your inventory to what is sitting in the general ledger, and you would have to make adjustments accordingly to your inventory balance, because it's important that at the reporting date, that the balance that you reflect on your financial statements shows the actual cost or the actual value of the inventory that you have on hand. Okay, now for smaller businesses, okay, they tend to use the periodic method. Okay, and the periodic method basically means that we are going to periodically update our inventory records. And typically what would happen is that at the reporting date, okay, we are going to update our inventory account in the general ledgers. Okay, so this would happen at the reporting date, and then we would subsequently calculate our cost of sales as well. Now, in the meantime, though, we are not able to use our inventory account. So when we have inventory that comes in from a supplier or inventory that goes back to our supplier, we would record that in a purchaser's account. Okay, so any movement of inventory between us and the supplier is then recorded in a purchaser's account. And at the end of the year, when we do our reporting, when we do our adjustments and our closing journal entries, we are going to have to ensure that we are calculating our cost of sales. And just the way we would do this is, okay, if you have your let's say you have your inventory account, okay, your inventory account, and you would also have a purchaser's account, okay, and you would have your cost of sales. Now, in the perpetual method, this is not relevant because whenever you sell, you are calculating your cost of sale at the point of sale, so you don't need to go through this exercise, whereas with periodic you do have to do this at the reporting date. So it's important to understand that in my starting point at the reporting date, in my inventory, I have the opening balance, and so that opening balance I'm going to actually take to my cost of sales account. Then I need to go and recognize my new closing balance, and in recognizing the new closing balance, the contra account again goes to my cost of sales. And then I also need to take into account that in my purchases account I've recorded all of these purchases, and this purchases account again must end up in my cost of sales. So in fixing the inventory account at the reporting date and in closing off my purchases at the reporting date, I in effect am calculating the correct cost of sales figure at the end of the year. And like we said, this happens periodically, so it's typically just going to happen once at the end of the year. Now, another thing to consider when we're dealing with, because we're talking about the measurement of inventory, is how we calculate the cost of inventory. And typically with items of inventory, we have some leeway in terms of how we calculate the cost. Okay, now, if we have an item where this item is not ordinarily interchangeable, meaning I cannot take this item and swap it out with another one because it is so different. So think about something like a car. Okay, so if you have a car, let me do my version of a car over there. Okay, so cars today, they aren't really interchangeable because some cars have leather seats, some have a sunroof, some have cruise control, or whatever the case may be. Every car really is different and made to the preference of the buyer. And these costs are typically, they are kept track of on job cards by the business, and they can be linked to the specific car via some sort of serial number. In the case of a car, it's probably a VIN number. So because you can directly attribute all the costs that have gone into this car specifically, the method that we would use here is called specific identification. Okay, so we can specifically identify which costs are included in this car over here. However, some items are interchangeable. Okay, so if you go to let's say you go to a shop and you buy a can of food. Okay, so you've got a can, maybe it's a can of tomato. Okay, so it's a can of tomatoes. So this can of tomatoes is very much similar to the can of tomatoes right next to it on the shelf. And so these types of products, we say they are interchangeable. Okay. Okay, interchangeable. And if items are interchangeable, then we need to apply a costing formula. And in terms of IAS2, the costing formulas that we can use are FIFO, so that is first in, first out, or the average cost. And the implication of these are that it's going to impact, right, the costing. So FIFO means that the first cans of tomatoes that come in are the first that then get sold. Okay. And weighted average cost means that you just take the cost of all the tomatoes you have on hand and you calculate the average cost. Okay. Then moving. Okay, so still talking about measurement. Okay, because measurement is quite a lot to cover, even though this is just a basic overview. So again, with measurement, I said the central principle is that inventory must be at the lower of the cost or the net realizable value. And we've spoken a lot about the costs so far. So let's talk about net realizable value. Now, IAS2 defines inventory's net realizable value as the estimated selling price in the ordinary course of business less the cost to complete the sale. Okay, so let's say that you can sell your item for 100 Rand, but in order to complete the sale, you need to spend 10 Rand to be able to complete that sale. So maybe you need to fix something on the product or whatever the case may be, right? The net realizable value in that case is 90 Rand because that is the net amount that you expect to get from selling this item. And so this net realizable value, right, we always are comparing it to the cost of the item because this is going to give us an indication of whether we should impair our asset or not. Now, when does this become an issue? Okay, so whenever you see things like the inventory is damaged. Okay, so if inventory is damaged, then this gives you an indication that the net realizable value may be lower than the cost potentially, or if inventory becomes obsolete. Okay, so obsolete, it's slow moving, it's no longer selling as well as it used to. Again, this could give us an indication that our net realizable value has changed. And if the net realizable value has changed, we always need to bring it back to what the cost is and see, do we actually need to write down our inventory? Now, talking about write-downs, with inventory, we have a related expense, okay? So whenever inventory gets expensed, that expense goes to cost of sales. Okay, and this is a very important thing to understand because I know that at the beginning of doing inventory, students tend to get really confused because they don't understand, well, why if something is lost, and I write it down, does it go to cost of sales? Because that's not a sale, so why would it be cost of sales? The important thing to understand is that cost of sales just encapsulates all the expenses relating to inventory. Okay, so if there is any expense for inventory, that expense must go directly to the cost of sales. Okay. The other thing to note with the cost of sales is that when we sell our inventory, we recognize the cost of sales in the period. okay, that we are recognizing the related revenue. So there is a matching going on there between the revenue and the expense, okay. And also any write-downs, okay, write-downs or impairments, okay, of inventory are going to go straight to cost of sales. The idea being whenever we credit inventory, okay, and we're recognizing a related expense, that expense must be cost of sales, okay. And then the last thing to keep in mind is with the presentation and disclosure. Okay. So in terms of presentation and disclosure, inventory, okay, is going to be disclosed on the statement of financial position, okay, as a current asset, okay. We have inventory over there. Now in the statement of profit or loss, we would perhaps see our cost of sales, okay, and that really would depend on the nature of the business. So when we get to manufacturing inventory, we'll see that there's a different way to present our statement of profit or loss. We could present our expenses by nature, but when the expenses are presented by function, then we would see cost of sales related to our inventory over there. And within the disclosure, we would also give a breakdown of what our inventory is made up of, but I'm not going to get too deep into that now because a lot of those disclosures are only really going to make sense once we understand manufacturing inventory. So big picture, that is inventory. Those are the basic principles that you need to understand in order to grasp what IAS2 really is about. Check in sometime again for that video that I'm going to do on manufacturing inventory. It is on my list of to-dos, but I'm just getting a whole lot of requests for so many videos, so I'm just trying to work through all of them systematically. I hope that this video was useful for you, and I will see you in the next one. Bye bye.